If you paid your credit card off in full last month, you probably think you won. You didn't. Your bank has quietly filed you under a word, and it is not responsible. The word is deadbeat. You will never see the label or feel it being applied, but that is the industry's real term for a customer who pays on time and in full, because that customer earns them almost nothing. If you've paid in full even 3 months this year, that customer is you, and you are worth about 55 cents a month. The customer sinking in debt earns them about $60.50 a month from the very same card. The good customer is worth 100 times less than the bad one. So here's the question that unlocks everything about your credit score. Why would a system be built to quietly reward the person who is worse with money and shrug at the person who is better? To answer it, you have to understand what your credit score actually is. The real mechanics, not the myths you have been told. And then the one thing that number is very carefully designed never to see. This is a system, by the way, that once let the social security numbers of 147 million people walk straight out the door and then mailed the victims checks for about $5 each, while still calling you the risky one. Hold that image. We will come back to it. First, the number itself. Let us start with what it is, honestly, because most of what floats around is wrong. Your FICO score, the one that actually gets used in the overwhelming majority of lending decisions, is a single number between 300 and 850. Roughly speaking, below 580 is poor, the high 600s is good, and above 800 is exceptional. That number is built from 5 ingredients, and this is the part worth memorizing because 2 of them are almost the entire game. The biggest slice, 35% of your score, is payment history. Do you pay on time? The second biggest, 30%, is utilization, which just means how much of your available credit you are actually using. Those 2 together are 65% of everything. The rest is split 3 ways. How long you have had credit, 15%, the mix of types you hold, 10%, and how much new credit you have applied for lately, 10%. That is the whole formula. Pay on time, keep your balances low, and you have handled 2/3 of your score. One caveat worth knowing, those percentages are for the general population, and they shift around for people with thin or short credit files. Now the myths, because they cost real people real money. Myth 1. Checking your own score hurts it. It does not. When you check your own score, that is a soft pull, and it is worth exactly 0 points. You could check it every single day forever. It is only when a lender pulls it to hand you a loan that it counts as a hard inquiry, and even that costs you fewer than 5 points and fades within a year. So check your own score obsessively if you like, it changes nothing. Myth 2. Shopping around for a mortgage or a car loan wrecks your score with a pile of inquiries. It does not. The system knows that 10 mortgage checks in 2 weeks is one person buying one house. So it bundles every mortgage or auto inquiry inside about a 45-day window into a single one. Credit cards, be warned, do not get that mercy. And here is the one almost nobody gets right. Myth 3, the famous one, that you must keep your utilization under 30%. That number is not a FICO rule and it is not a law. It is a widely repeated rule of thumb. FICO itself says there is no magic number. Lower is simply better. One last fact almost nobody is taught. To have a score at all, you need one account, at least 6 months old, and reported to a bureau in the last 6 months. That is the whole bar. Keep that one in your pocket. It is about to matter. So that is the machine, and it looks perfectly reasonable. Pay your bills, do not overborrow. But now look at it again and notice what is not there. Nowhere in that formula is your income, not your salary, not your savings, not the balance in your checking account, not your investments, not your house, not your net worth, none of it. You could have $1 million sitting in the bank and it would not move your score by a single point. FICO will tell you this flat out. The money you save does not affect your score. Sit with how strange that is. A number that supposedly measures whether you are good with money does not look at how much money you have, how much you earn, or how much you have saved. It looks at exactly one thing: how you handle borrowed money. Every single input is a measure of your behavior as a borrower. And that is the hinge this whole thing turns on. Your credit score is not asking, are you good with money? It is asking a completely different question. Are you good for a lender? Those sound almost the same. They are opposites. Because the person who is genuinely, boringly great with money, no debt, pays cash, saves hard, can end up with no score at all. The system has a name for them too: credit invisible. And it is not a tiny group. Millions of American adults have no score, and it falls hardest on the people with the least and along racial lines. Roughly 15% of Black and Hispanic adults have no credit history, against about 9% of white adults. Do everything the old advice told you to do, owe nothing, and the system simply cannot see you. To understand why it is built this way, you follow the money, the lender's money. In 2022, the Federal Reserve broke down how credit cards actually earn their profit, and the answer is blunt. Around 80% of a credit card's profit comes from one single thing: interest on the balances people carry. Not the swipe fees, not the annual fees, interest. In fact, the Fed found that the basic job of the card, you buy something and they process it, actually loses the bank money, around 4 cents on every dollar. The card only turns profitable when you fail to pay it off. Now go back to that word, deadbeat. The customer who pays in full never touches interest, so they sit on the losing side of the ledger. The bank puts up with them. The customer they actually want is the one carrying a balance, month after month, year after year. And the split is stark. The heavy borrowers, only about 1 in 5 accounts, carry more than half of all the debt and pay nearly 3/4 of all the interest in the entire system. That is the engine of the whole business. And your credit score is the instrument that keeps it running, a tool for finding, sorting, and pricing the people most likely to borrow and pay interest for decades, which is exactly why the debt-free person goes invisible. Remember that 6-month rule. Stop borrowing completely, close your old accounts, and within 6 months the system has nothing recent on you, and your score can simply vanish, and you would not feel it go. There is no warning, no letter. One day you go to borrow and find the machine no longer has a version of you it knows how to price. Think about what that tells you. A number that deletes the person who owes nothing was never measuring financial health. It was measuring how useful you are to a lender. And the scale of what it keeps flowing is staggering. Americans are paying somewhere around $160 billion in credit card interest in a single year. Not borrowing, interest. That is the engine, and it runs on more than $1.2 trillion of debt at rates that now average north of 25%, the highest in decades. So if the score is built to serve lenders, then who builds it and who gets paid? This is where it stops being an idea and becomes a business. And it is a business almost no one looks at directly. Start with the score itself. That FICO number was invented by one private company, Fair Isaac, and its core formula dates back to 1989. To be fair to them, what came before was worse. For most of the last century, whether you got a loan came down to a banker's gut, a subjective judgment about your character, your appearance, your job, your neighborhood, and it was often nakedly discriminatory. The algorithm was, in a genuine way, an improvement. It judged everyone against the same rule instead of one man's prejudice. Hold that thought, because it is the honest defense of the whole system. But fairer than open bigotry is a low bar, and being consistent is not the same as being on your side, because look at what that one company built. By FICO's own reporting, its score is used in around 90% of major US lending decisions, and it issues something like 27 million scores a day. And here is the beautiful part: if you happen to be FICO, they do not lend you a cent, they take no risk, they just sell the number. On the score side of their business, that runs at roughly an 88% operating margin. For every dollar that comes in, about 88 cents is pure profit. It is one of the cleanest tolls in modern business, a private tax on nearly every loan in the country, and they have been quietly raising it. The wholesale fee for a credit score used in a mortgage climbed from around 60 cents a few years ago to about $10 for the exact same 3-digit number, which has now pulled in a Senate investigation and a state subpoena. Then there are the 3 bureaus that actually hold your file: Equifax, Experian, and TransUnion. And the way that works should bother you. The lenders hand your behavior to the bureaus for free. The bureaus package it up, and then they sell it back to the lenders. You never signed up for this, you cannot opt out of it, and you are not the customer in that deal. You are the inventory, and that is not some critic's spin. The government's own Consumer Financial Protection Bureau described it in writing as a system where consumers are the product, not the customer. And if you ever needed proof that you are not the one being protected, look at what happens when they fail. In 2017, Equifax was breached, and the private financial details of about 147 million people walked out the door. Names, birthdays, social security numbers, people who never signed up for Equifax, who did not even know the company held their entire financial identity, had it stolen. And the consequence? Equifax agreed to a settlement of up to $700 million, which sounds enormous, until you learn the actual cash pool for victims was so thin that many people who filed a claim received a check for around $5. The chief executive departed with a retirement package worth tens of millions. If you had been the customer, losing your data would have been a catastrophe for them. You were not, so it was a rounding error. And then, the final twist. They sell it back to you as well. Those friendly free credit score apps, the ones that cheerfully ping you about your number. The biggest of them, Credit Karma, was bought by Intuit for $8.1 billion. And it made something like $1.7 billion a year, not by charging you a cent, but by using your own data to match you with loans and cards and taking a fee every time you signed up for one. You were the product there too. Meanwhile, the one thing you are actually entitled to, your real credit report, is free by federal law at a government-mandated site called annualcreditreport.com that almost nobody ever visits. So here is the whole thing, finally. Your credit score was never a report card on your character. It was never a measure of your wealth, your discipline, or whether you are, in any real sense, good with money. It is a profitability forecast. A single private formula written in 1989 that takes one question, how much money can a lender safely make off this person, and compresses the answer into 3 digits that the entire economy has quietly agreed to treat as the truth about you. Once you see that, the deadbeat paradox stops being a paradox. Of course, the system rewards the borrower and shrugs at the one who pays in full. That is what it was built to do. But seeing it clearly hands you the controls. 2 levers, paying on time and keeping your balances low, are 65% of the entire score. So play the game perfectly and stop believing the lie underneath it. Pay in full, wear the word deadbeat like a badge, and never again mistake a high number for a compliment. It only ever meant that you are good for them. So, an honest question now that you know what it is actually measuring. Are you going to keep chasing a higher score, or are you going to be a deadbeat and proud of it? Tell me which one you are.